talking about the Federal Reserve System. Okay, now what's always interesting about the Federal Reserve System, as I've mentioned before, is that it's often, we call it the Fed, right? It's kind of the catch-all phrase of the Fed, and we hear this all the time as if it's a single institution. But what's interesting about the United States and the way that we do central banking is it's very unlike European central banking. European central banking is very centralized. It's one institution that is making these decisions. Here in the U.S., we've had kind of a very sordid history when it comes to centralized banking. The Federal Reserve itself is not new. It's not exactly old either, right? But it did not come about at the same time as other central banks, and especially at the same time as the United States when it came to its inception. We did have what was called the Bank of the United States. So if we want to talk about the pre-Fed kind of era, right? Now, we had what was called the First Bank of the United States and then the Second Bank of the United States. And the dates are unimportant because this isn't a history class, right? But we did have some sort of national bank, right? There was a couple national banks that eventually was suspended by President Andrew Jackson when he basically said, I don't like banks, I don't want a centralized bank, I don't want a government bank, none of that, right? So what happened during this pre-Fed era is the banks themselves, what we call the Bank of the United States, okay? Again, there was two versions of it, but they were what was known as a lender of last resort. Right. Now, what we mean by lender of last resort here is when commercial banks are really having problems. These are the banks that you and I would go to. They could go to each other for help, right, if there were problems. But largely what we saw is that they would actually need an extra hand, right, and to go to the government. And so they needed some sort of banking system in which that they could go to when things really got bad. And that's what we had for a long time. But once the Bank of the United States was eventually suspended around the early 1800s, right, where we just said, we're not going to do it anymore, we entered into a realm of what was called free banking. There was no centralized idea, right? There was no central bank. That, yes, there was a unified dollar in which everyone used, but different banking institutions could print their own money. And there was a lot of regulations as to how this would work. But it was that. I mean, if you notice on a dollar bill, and I don't have one on me because I never have money on me, right? You'll know it says Federal Reserve Note. But it didn't always say that. You can find older bills that were, again, official U.S. tender, that would actually say J.P. Morgan Note. It would say, Chase Bank Note, Manhattan Bank Note, right? And we would see this, that there was multiple banks with all the same U.S. dollars, but eventually that started to corrode and become problematic. And as we mentioned before, if we look at historical data, the monetary history of the United States, especially during the 1800s, the business cycle would go up and down, would oscillate quite a bit, right? There'd be one or maybe even two recessions a decade, right? And very severe ones too. So what we eventually saw was a number of different either contractions in the economy or what became known as panics, right? And we got to a very famous panic called the Panic of 1907. It's a very famous contraction, and since, it was a panic, right? It was a market drop around this time. And it still gets debated today as to what was the best way to handle this. Did we do the right thing? Did the government step over too much? Should it not have? Did the market work? Did it not work, right? And what were some of the important things that kind of happened at this time, right? Again, we don't have to go into the hugeness of all the historical details and things, but there was a lot going on at this time. This happened roughly around October and November of 1907, right? We're getting to the year end here. One key significant fact that happened was the New York Stock Exchange itself fell by 50%. Okay, that went down by 50%. So it got sliced in half, right? Huge hit to the market, right? But there was all these other problems going on here. Was it just the stock exchange falling that caused the problem? Well, you know, economists, right? The exchange and stocks and all that, while we find it interesting and it is a good marker for certain things, we don't look at it as a huge indicator for what's going on, right? So what we're actually seeing at this time was that this was not even a catalyst, but was really the straw over the camel's back that eventually said, you know what, this isn't going to work, right? There was a number of other factors going on that were problematic, right? Some of them were, as we've mentioned before, sorry, you guys can hear my family, right? The copper market fell, right, which is a huge market at the time, right? That went down. We saw Union Pacific, major railroad company, was starting to have major problems, right? Okay, so you have one really big company was having a fall. You had a huge drop in a certain industry, and then we also saw another major one was Standard Oil. Right, Standard Oil, massive company. If you've seen, the movie There Will Be Blood with Daniel Day-Lewis, right? It was actually a book by Upton Sinclair. Was based upon really not 100%, but based upon what was going on with Standard Oil at that time and their growing monopoly power. And one of the problems with Standard Oil is they got hit with antitrust lawsuits by the government, right? They were sued for monopoly power here. Okay, so we had the copper market was taking a hit. Union Pacific, major railroad line, major company taking a hit. Standard Oil, another major company, was now being broken up. They hired a lot of people, a lot of things going on. And then on top of all that, right, there was a few other things that were happening. We saw there was a major earthquake in San Francisco. Not a huge shock, right? Right? There was a major earthquake in San Francisco, and a lot of money from the economic and financial hub of the United States out there was then being sent over, right? Was being sent over to the West Coast. Now remember, there's no centralized institution here that is going to actually get all this money out there, right? They have what they have. And all the money from the banks was going out to loans and rebuilding efforts and stuff like that over to San Francisco. So now there's actually a shortage of actual cash, right? We actually start to see the money supply here starts decreasing. The physical amount of cash that people can get their hands on, businesses, households, local and state governments, all of that, right? The money supply starts decreasing now, starts going down, okay? So a lot of that money is leaving there, and also the market is starting to shrink. So the value of assets and capital is going down, but we're also seeing money leaving. And then on top of that, we saw a lot of money going towards food purchases. Right, so again, more money that is leaving the East Coast and going out towards Middle America, right? So we see increasing purchases for food. The harvest comes in, right? So all of a sudden, all this money is leaving New York, right? Leaving the East Coast, the financial hub of the United States. We're seeing the money supply is going down, and then we see all of a sudden a massive hit. What sparked this hit? something called the Knickerbocker Trust, right? The way I explain it is, if you think about the recession of 2007-2008, right? There was a lot of little things going on, housing market, AIG, all this kind of stuff. But what we found out was the main catalyst. You had Bear Stearns, you had Lehman Brothers, right? Once we saw them start to collapse, it started to show little fissures in the economy, and the financial market slowly started to go down. Okay, and that's what happened here. All these things were already, looming in the background, and then this Knickerbocker Trust collapsed, causing a massive cut in the New York Stock Exchange, amongst a bunch of other things, right? And then we had this panic. Right? Now, how the solution came about, it actually involves the original J.P. Morgan. He united a bunch of bankers to really get the money, and they said, look, we got to put it in there, because there was runs on the banks, right? That was a big thing, right? What we call, runs on the banks. Right? Now, we've heard this term before. Right? What does this mean when there's runs on the banks? Right? The idea is that people all of a sudden panic, as we know recently. Right? People panic. They're worried that everyone's going to go to the bank and get their money out, and then when you need money, that bank's not going to have any. It's interesting because now we think of it, in this day and age, it's kind of like, well, of course the bank's going to have my money, right? My money's there. What do you mean the bank doesn't have any money? Right? And we have FDIC, right? Your account gets backed, each account gets backed by the government for, I think it's up to $250,000 now, right? So as long as you got it under $250,000, if you have more than that, you need two accounts, by the way. But as long as it's less than $250,000, then the government will ensure that they will have your money, okay? So the problem back then was they didn't have that, right? You weren't sure if you were going to get your money. Okay, so they wanted to avoid this, but then this actually happened globally. This wasn't just in the United States, right? The economy has always been global, right? It's not anything new. The economies have always been global, okay? So we had all these runs on the banks, and all of a sudden there was just no money, because all the money had left. It was out on the West Coast. It was out in the Midwest with food. Not that they shouldn't have had it, but it was in New York where all this was happening. The value of stocks and assets and portfolios were starting to contract, and it caused a massive, massive, massive problem, right? So all of this happened. Okay, we got out of it. How we got out of it? Okay, it's a longer story, and it's interesting. And there's a lot of books written about the panic in 1907. Both, should the government have done more? Should they not? And all those wonderful things. But the question was, what do we do after it? Right, and that's where we get the birth of what we call the Federal Reserve System. Okay, so the Federal Reserve System itself had a longer history even before the panic of 1907. Right. It had been kind of in the works, and people had been talking about it for quite some time. Economists and certain senators that were favorable to it, except there was an issue with it. Generally speaking, in the United States, there's two things that, kind of culturally, not individual, we're talking broad brushstrokes here, generally and culturally, that Americans tend to have issues with, right? One of them is centralized power. And the other is banks, right? I don't care if you're left of Democrats or right of Republicans, everyone tends to have a problem with banks and banking, right? Conspiracy theories are abound. And the other is, of course, centralized power. We have a history. I mean, our entire political system is based on the idea of checks and balances, right? So the European model of central banking just didn't cut it. Right? It would never pass Senate, it would never get through Congress, the House of Representatives, and all those wonderful things, right? So they had to come up with an idea. So there was a group of, again, senators and economists, who they are is not important, and they met at this place called Jekyll Island. I know it sounds, like a Bond villain's, base or whatever, and fair enough, right? They met at this place called Jekyll Island, which is still around. It's a country club off of North Carolina, I think it is. I've never been there. It's very expensive. They met, and they met purposefully outside of Washington, right? And they went outside of Washington because they didn't want rumor to spread, and they didn't want the bill to die, on command. So they wanted to get everything together, get it written out, get it ready, and then they would present it and advertise it, and it worked, right? And we got to this Federal Reserve Act of 1913, right? The Federal Reserve Act of 1913. Okay, which established what we called the Federal Reserve. All right, the Federal Reserve System. Okay, now unlike European central banking, the Federal Reserve System is actually a number of institutions that have really checks and balances on each other. Okay, so it's not like there is the Fed. Okay, there's actually a bunch of small institutions, part of this Federal Reserve System, that have various interactions and checks and balances, which create what we call the Fed. But it's actually a bunch of separate institutions, and it was made that way on purpose. Okay, that's the key part. All right, it was made decentralized, right? Because they knew that if it was like the European model of one central bank, it was never going to pass, right? It was never going to pass. And even today, people argue that, this shouldn't have passed and all that. It's very few, it's a minority opinion, but it's still an opinion, okay? So, what then is the Federal Reserve? Well, it should be noted, and we're going to keep coming back to this, that at the point, the Federal Reserve System and what we call the Fed, right, had a single charter, a single mission, which has changed. But at the time, again, it was the lender of last resort. Right? That the original Fed charter was to be the commercial bank's bank. That they would lend to commercial banks as long as every other option had been exhausted, and there it is, right? Then they could go to the Federal Reserve. You and I, unless you're an incorporated bank, which I'm assuming that you're not, but you and I cannot go to the Federal Reserve and actually borrow money. You have to be a state chartered bank to actually deal with the Fed. Okay, you have to be a legitimate enterprise. You can't be a loan shark. You can't be an average person, right? You have to be a legitimate bank to actually deal with the Fed. And then in some unorthodox situations, firms, and we'll get to that later. Okay, so that was the original. So then what is the Federal Reserve System then? What is it? If it's all these institutions, what are they? Well, we're going to limit it to kind of the big ones, because there's a lot of small institutions within there, different advisory boards and things like that. But it actually is made up of three, really the main meat of them. Okay, we have what's known as the Federal Reserve regional banks. We have what's known as the Board of Governors. And then most famously, and probably what is constantly talked about when we say the Fed has increased rates or decreased rates, what are we really talking about? We're talking about what's known as the FOMC, the Federal Open Market Committee. Okay. And these three here have relative checks and balances. There's certain things the Board of Governors does here, and then there's certain things that the Fed regional banks do with the Open Market Committee, and likewise, and there's all these different ways that they interact with each other, okay? Now, before we get into what exactly they are, and they're pretty interesting as to all these things, the question that always comes up is the Fed part of the government, right? It's an interesting question, right? Is the Fed part of the government, or is it a private institution? And like most economic answers, the answer it's yes and no, right? Is it part of the government? Kind of. Is it a private institution? Kind of, right? But if you had to put it on it, you could say that it's a quasi-public institution. But in reality, it is a private institution with government involvement, okay? So when we talk about the Federal Reserve, I know it's got the word federal in it, and so people think it's part of the government, but it's kind of really not. It works, I don't want to say hand in hand, because it has to maintain independence, and we'll talk later about why that's important. But it has to maintain a certain level of independence, but it does work with the Department of the Treasury pretty well and very closely, especially when we get into the specifics of how they run things. So is it part of the government, right? Is the Fed the government? Is the Fed part of the government, right? The question that we get all the time, right? Is the Fed part of the government? And like I said, the answer is yes and no, right? And when we go through these, we're going to find out which ones here really show independence, private, and which ones are very government involved.